Taking a look at the market right now, Nuburu, trading under the ticker BURU, is in the middle of an absolutely chaotic intraday session. The stock is currently trading at $0.3311, which is a staggering 8.05% drop on the day. The volume is astronomical, with over 78.4 million shares having changed hands already. This isn't a quiet drift downward. This is a high-volume, aggressive rejection by the market. And what makes this so compelling and frankly so confusing for many is that this collapse is happening just one day after the company announced what should have been incredible company-altering news. Yesterday, Nuburu put out a press release stating it was entering a strategic alliance with Maddox Defense to form a joint venture aiming to build next-generation military and commercial drones. They even estimated the total addressable market at over $7 to $10 billion annually. When a microcap stock trading for pennies announces it's entering the multi-billion-dollar defense and drone space, the common expectation is a massive multi-day rally. Investors, especially on retail forums, are programmed to see drones, defense, and strategic alliance and assume the stock is about to clear $1. The reality, however, is what we are seeing on the screen right now, an 8% crash on volume that suggests institutions are not buying this story. The market is not celebrating, it's liquidating. This disparity, this chasm between the press release and the price action, is where the real story lies. The immediate question is why? Why is the market treating what sounds like transformative news as a non-event, or worse, as a catalyst to sell? To understand this, we have to look past the headline and at the company's recent history, which has been anything but stable. The drone joint venture news did not happen in a vacuum. It came after a string of deeply troubling regulatory and financial events. Just last week, on October 13th, Nuburu disclosed it had received a formal warning letter from the NYSE American Exchange. This wasn't a warning about its stock price, it was a compliance failure. The company apparently announced a new, highly material dual CEO structure and a broad transformation plan during market hours without properly notifying the exchange first. This is a rookie mistake, a significant procedural violation that undermines investor confidence. It suggests the company's internal controls are weak. Then just a few days ago, on October 16th, the company issued another release claiming it had restored compliance. But this was all happening against the backdrop of an even more serious threat. An 8K filing from October 7 confirmed the company had received a notice of delisting or failure to satisfy a continued listing standard. While the drone news is forward-looking and aspirational, the NYSE warnings are here, now, and very real. The market seems to be weighing the promise of future drone revenue against the reality of a company that is struggling with basic exchange compliance and fighting to keep its stock listed at all. The 78 million shares trading today suggest the market has made its choice. The regulatory risk and financial instability are outweighing the speculative drone hype. This brings us directly to the short seller thesis, because this stock is and has been a significant target. The most recent publicly available data shows Nuburu has a short interest of nearly 17% of its float. That is an exceptionally high number, indicating a significant portion of the market is making a direct, leveraged bet that the share price will continue to fall. With a stock this volatile, many retail investors see a high short interest and immediately think a squeeze is possible. But here the data tells a different story. The days to cover ratio is currently sitting at just 0.09. That is not a typo, because the average daily volume has been so extraordinarily high, driven by today's 78 million shares, the 12.8 million shares currently held short could be bought back and covered in a fraction of a single trading day. This means the shorts are in no danger of being trapped. They have all the liquidity they need to exit their positions whenever they want to. A short squeeze is, based on this data, effectively impossible. The shorts aren't sweating, they are in control. So what is their thesis? They're not shorting the technology, they're shorting the balance sheet. A look at the company's financials is horrifying. The most recent quarterly report from June showed a net loss of over $12 million. The net profit margin is negative 400,000%. The gross margin is negative 8,900%. But the most stunning number of all is this. Over the last 12 months, shareholders have been diluted by an almost unbelievable 1,793%. The company is burning cash at a ferocious rate and is funding its operations by printing and selling new shares at an alarming pace. This is the short thesis. They are betting that the company will run out of options before its technology ever becomes profitable, and that it will have to continue diluting existing shareholders into oblivion just to keep the lights on. The drone joint venture, from this perspective, looks less like a new business line and more like a desperate attempt to create a story that allows them to sell more shares to a new round of hopeful investors. Do you think this drone news is a legitimate strategic pivot, or is it a last-ditch effort to distract from the delisting notices and catastrophic dilution? Let me know your take in the comments. What's even more concerning is the data on settlement failures. In September, Nuburu appeared on the fails to deliver or FTD list with massive numbers. At points over 8 million, 6 million, and 4 million shares failed to settle on their required date. While FTDs can happen for various reasons, chronic and large FTDs in a microcap stock can be a sign of extreme market stress, naked short selling, or a chaotic inability to locate shares for borrowing. This signals that the market structure around BURU has been, at least in the recent past, highly unstable. For any retail investor, this is a massive red flag. When you buy a stock, you expect to receive your shares. This data suggests that at times, the plumbing of the market for BURU was breaking down. Now, all this financial and regulatory turmoil completely overshadows what the company actually does, which is on paper quite interesting. Nuburu is a specialist in high-power blue laser technology. This is a legitimate and important technological niche. Traditional infrared lasers, which are common in industrial manufacturing, are not very good at processing reflective materials like copper or gold because the light simply bounces off. Blue lasers, however, have a much shorter wavelength and are absorbed much more efficiently by these materials. This makes them ideal for high-speed, spatter-free welding of copper components. And where is copper in high demand? Electric vehicle batteries, high-power electronics, and consumer electronics. The bull case expectation for Nuburu has always been that it would become a key supplier to the EV and battery manufacturing industries. The reality is that this technology is capital-intensive to develop and scale, and Nuburu is competing against multi-billion-dollar industrial giants. It appears they have been unable to gain commercial traction fast enough to offset their severe cash burn, leading to the financial crisis they face today. This is a company owned almost entirely by the general public. Institutional ownership is less than 1%. The big index funds from Vanguard or Geode that are listed as owners hold tiny, passive positions as part of their broad market funds. There are no major active institutional investors here. No prominent hedge funds have a long position. This is a 94% retail-held stock, which explains the extreme volatility. The stock's behavior is driven entirely by press releases and sentiment, not by fundamental analysis from large firms. This also means that when negative news hits, there is no institutional floor to stop the price from collapsing, which is exactly what we are witnessing. So what happens next? The future outlook is binary and precarious. The bull case, which the market is clearly not buying, is that this drone joint venture with Maddox Defense is real, funded, and will generate revenue fast. The company also recently announced an acquisition of a company called Orbit to build out its defense portfolio. If these moves generate cash now, they might be able to slow the dilution and stabilize the share price. They could theoretically use this new defense narrative to raise capital on better terms, but this is a long shot. The bear case, which the market is pricing in, is that this is all just noise. The company will continue to burn cash, it will fail to regain compliance with the NYSE American Exchange, or it will be forced to execute a reverse stock price, for example, a 1-for-20 or 1-for-50 split, just to get its share price back above the $1 minimum. A reverse split, as any seasoned investor knows, is often the prelude to more dilution, as it gives the company a higher price from which to sell new shares, wiping out even more retail value. For those of you holding shares of Nuburu, comment below on what your plan is. Are you holding on for the drum dream, or has the 1,793% dilution been too much to bear? To find information on short interest, investors can look at the official data published by the exchanges themselves, like NASDAQ or the NYSE, which is updated twice a month. This will give you the official share count and the days to cover. For more real-time data, you have to look at borrow fee rates. You can often see this right in your own brokerage platform. If you try to short a stock and your broker says shares are hard to borrow, or the fee is 10, 20, or 50%, you know that demand to short the stock is incredibly high. Right now, BURU's borrow fee is elevated around 10%, which is costly but not astronomical. This tells us that while the short thesis is strong, it's not a panicked, crowded trade, it's a confident fundamental bet against the company's solvency. In summary, the story of Nuburu today is a perfect and painful example of expectation versus reality. The expectation fueled by yesterday's press release was a high-tech pivot into the multi-billion-dollar defense drone industry. The reality, demonstrated by today's 8% crash on 78 million shares, is that the market sees a company on the brink of delisting with a history of compliance failures, negative 400,000% profit margins, and 1,793% dilution. The market is screaming that it does not believe the new story. It is laser-focused on the toxic financials and the compliance warnings. The high-volume selling suggests that any investors who bought the hype yesterday are being liquidated today. The shorts are firmly in command, and with a days to cover of 0.09, they face no risk. This isn't a battleground stock. It's a fundamental collapse that a single press release about drones could not stop.